Hello, I hope everybody's doing well. I wanted to get on today and just give a couple of updates in terms of terminology and some of the things you're going to see this week, and to kind of just give a little bit of an overview and kind of have a late week check-in as far as that goes. So I'm going to begin by opening up Excel and get us ready to look over some problems. But just kind of thinking about this chapter as an overview. Really, when we were looking at chapter 1, we were learning about accounts, the types of accounts, assets, liabilities, equity, revenue, expenses, and we would look at examples where you might begin with a certain balance, and then we would use a negative number. And of course, in this week, we learned that the normal balances of certain accounts behave a certain way. For instance, assets, drawing accounts, expenses are increased with a debit entry, and the normal balance would be a debit balance, so an entry on the left side, whereas liabilities, capital, and revenue are increased with a credit entry, and would then of course have a normal balance as a credit balance. But I wanted to talk through a couple of other terms and some things you might see, and just kind of give some general thoughts on what to expect. And so just in terms of terminology, some of the things you'll notice, you've got some accounts that refer to receivables, and really anytime you hear the term receivable, that's money coming into you. You've got something coming into you. So I provide a service for somebody, and they pay me with a receivable. Let's look at that transaction real quick. If I do that, let's say I provide a service, and we'll say that I'm in a consulting business, and a person pays me on account. They haven't given me cash at this point in time. I'm going to recognize that as a debit to accounts receivable and say it's $500. I'm going to recognize that as a credit to consulting revenue. And in this example, both the asset, account receivable, and the revenue item, consulting revenue, are increased. Assets are increased by debit. Revenue is increased by credit. And I'm going to put it to just a description: provided services on account. So that's part one of the transaction. And if I'm assigning a general ledger number to this, again, when you think about general ledger numbers, and you probably noticed this in your text, the number 101 was assigned to cash. So as a general rule of thumb, when you're looking at an account and it's got a 1 in front of it, at least for the purposes of this text, and really throughout the remainder of this course, anything that's got a 1 in front of it's going to be denoted as an asset. A liability would begin with a 2, an equity account would begin with a 3, revenue 4, and of course expense 5. So the way that these accounts are grouped is their closeness to cash. So there's nothing closer to cash than cash. That's why it's got the description 101. Accounts receivable might have a description of 121, which means it's a pretty low number still, but it's a promise to pay. It's not cash at this point in time. Consulting revenue, again, if this is my primary course of business, this is how I make money, it's going to have a pretty low number as well. So maybe 411 or something like that. Okay. So let's go forward with another example, and let's assume that the customer that I provided service to comes back and says they want to pay off the amount that they owe. How I would recognize that is I would have a debit to cash for $500, and then I'm going to credit the receivable. I need to offset that a little bit. Also for $500. Provided payment on account. And let's date this. Let's say that this happened. Let's say this happened on 12/1. Maybe they came in and made a payment on 12/15. Paid at mid-month. If I look at what happened there, and be sure that you're aware of this. In this first example, I recorded the revenue. I recognized the revenue. In this example, you do not recognize revenue again. You've already recognized it once up here when you pulled in consulting revenue. All that's happening in this transaction is I'm exchanging one asset for another. I'm exchanging an asset that's close to cash in the form of a receivable for actual cash. So if I was to put this in a T account, what I find is the original entry, debited accounts receivable, credited revenue. This payment debits cash, credits accounts receivable. And so the effect in accounts receivable essentially is that these two items zero out. So at the end of the day, my balance in accounts receivable is now zero, but I've converted that to cash, and that's what I want to have happen. You may see the description prepaid insurance or prepaid rent, that type of thing, and wonder what that is. And you think about rent or insurance, and it would, logically you would think those types of payments are expenses, but in reality, they're actually assets. So for instance, if I look at, if I was to book an entry to pay a month's rent, I might call that, let's give it a GL number here, 510. I'm sorry, I'm gonna give it a date, 12/15 again. Let's say 510 or 511 is rent expense. And we'll say that's $1,000. And maybe I pay that with cash. Okay. In that instance, I recognize expense because if I'm paying month to month, that payment only gives me 1 month's worth of rent. If I want to get another month's worth of rent, I've got to then make a payment the following month and so on and so forth. But let's say, for instance, I paid a year in advance. What's going to happen at that point in time? Let's say we null and void this out altogether. And instead, we pay for a year's worth of rent. In that situation, I'm going to have an asset, prepaid insurance, and assuming $1,000 a month, I'm prepaid insurance, prepaid rent, that would be $12,000. And then my offset is going to be cash for $12,000 as well. Now, at this point in time, I have not recognized any expense whatsoever. However, at the end of this month, 12/31, I would at that point in time recognize rent expense of $1,000. And then my credit is not going to be to cash because I've already affected cash in this transaction. My credit is actually going to be to prepaid rent. And there's a reason for that. At this point in time, I have used up 1 month's worth of rent. So now the value of this asset is diminished by $1,000. So what was at one point in time a $12,000 asset is now an $11,000 asset. And the following month, it'll be $10,000 and so on and so forth until prepaid rent is down to zero. Now, why do we do it that way? If I was to take this full balance and recognize this entry, this $12,000 as an expense at the first month of the year, then for that particular month, I would have vastly overstated my expenses. Okay. For the remaining 11 months, I would be understating my expenses. And if I'm thinking about this from the standpoint of making informed business decisions, I really need to be able to factor out what is actually happening on a month-to-month basis. What is the real picture? What is really going on? Doing it in this manner allows me to do just that. I'm factoring out the things that are non-events, basically, and I'm looking at the true result of operations. By recognizing expense on a month-to-month basis, I get a realistic picture of where I'm at each month, and that helps me to then make better decisions going forward. Another type of account that you might hear of to some degree is unearned revenue. And as far as that goes, that's kind of the opposite to a certain degree. If you think about it, if I've got unearned revenue, then what's happening is I'm recognizing revenue, I'm recognizing income, and actually I'm recognizing cash for a service that I've not performed yet. So an example of that might be something like a like a magazine subscription, if I was to do that, or it might be some type of subscription to a service. A person may buy, a year's worth of services up front, or a couple of years up front, but yet I haven't performed that yet, or they haven't received the benefit of it at that point in time. What's going to happen there is I'm going to recognize a debit to cash or whatever type of payment that it was, and my credit is actually going to be a liability. It's going to be a liability of unearned revenue. And why is it a liability? It's because I have received cash, but I then have to honor that service over a period of time. Very much like when you incur a loan. Again, if you used a loan to obtain an asset, over time you're going to be making payments to pay off the value of that loan. In a similar manner, I'm doing this with unearned revenue. As I'm performing these services, I'm minimizing that liability at that point in time, and then I'm earning the revenue as it moves forward. That prevents me from recognizing everything up front at a time that the revenue has not been earned correctly. And again, similar to and almost kind of opposite of the prepaid, it allows me to match these events in the time period in which they actually earn and in which they're actually incurred. So that helps me to, again, get a better realistic picture of where I'm actually at. So if something does happen throughout the year, something abnormal, something I didn't anticipate, then I can really isolate that event without having these extraneous factors come into it and skew my data to some degree. So that's just a quick update. I just wanted to give a couple of terms and just kind of walk through a couple of examples. Again, if you have any questions, please feel free to reach out to me and let me know if I can help. Have a great day. Thank you. Bye.